still got the problem remaining of that GDP formula. How do we pay for this bloody debt? Because it keeps going up. The higher interest rates go, the more the bonds they have to issue, which is why I think they want to bring interest rates much lower than people expect by being so late in hiking, so they can undershoot and have the cover to paper over the cracks in the system yet again. And they'll use like the commercial real estate and the banks as one of the excuses to do it, to start using the balance sheet. But we've still got the problems with the economy, is it's not growing fast enough to pay the interest on the debt. So if the economy on average is growing at 1.75%, and let's say interest payments on debt is about 2%, and the government's 100% of GDP in debt, that's all of GDP just to pay the debt. So what you need is to grow GDP. And to grow GDP, you either need the population to grow. Well, that's not going to happen. We need productivity to grow. That's technology. So productivity growth is what I'm really looking at. And it's not this cycle story, but by 2030, we will see AI solve for both problems. AI and the robots are new demographics. They're new productive units in the workforce of infinite scale. So we can now have an infinite population of productive people in inverted commas, and that will start driving productivity. The next part of the equation is we need to bring the cost of energy per unit of output down. And it won't come out of fossil fuel markets, it'll come out of renewable energy plus nuclear energy. If you lower the cost, the average per dollar barrel of oil price over the last 60 years has been about $40, inflation adjusted. But if you change to a new source of energy or bring in other sources of energy to make an excess abundance of energy, and you bring it down to $40, at $10, that has a massive multiplier. So my big picture is we're about to go through an economic revolution, but we're not finished with the downside of slow economies. And that's going to mean more and more use of the balance sheets, ongoing increase in asset prices, and this ongoing cyclicality of the economy. The world hit an inflection point in 2008, which was the global debt crisis. And we get the ramifications that spread on in 2012, the European crisis. And that continues to rumble on to this day. What happened back then was something remarkable. Is if we think about how GDP is created, the growth of economies, it's population growth, productivity, and debt growth. We've had aging populations in most of the Western world. The US is less aging than others, but still aging. But debt growth in 2008 stopped, basically. And we had a debt jubilee. Now, debt jubilees, most people would think of, you forgive all the debts. We didn't. We did this magic trick, which we said, you don't need to pay the interest on the debt. We'll make it all zero. And every central bank around the world cut interest rates to zero. Okay, that created an opportunity for every government to refinance their debts. So they all refinance, and they refinance them in this 3 to 5 year time horizon. And that set off a cyclicality to the economy that we've never really seen before, that every 4 years we get economic weakness, the increases of the balance sheet and use of interest rates as they come to refinance the debt. What I found out in my work that's become quite well known called the Everything Code, I found out that, in fact, the use of the central bank balance sheets was used to pay the interest on the debt from the previous cycle. And this will become relevant in a second. So they're monetizing the interest payments, which is pure debasement of currency. And debasement of currency means that the denominator, the purchasing power of that currency, goes down, and it makes the price of assets look like they're going up. But they're not really going up. When you divide, for example, the S&P 500 or gold or real estate by the Fed balance sheet, they've been flat since 2008. And I discovered within that process that only 2 assets actually have risen versus the debasement of currency. That was technology stocks and crypto. Both were in secular uptrends. So this, like clockwork business cycle, which is based around the debt refi cycle, happens to be exactly the same as the US election cycle. It also happens to be exactly the same as the Bitcoin halving cycle. So all of these cycles are at the same time every time. So here we are today. Today, we're at the bottom of the business cycle. This is the kind of recessionary era. Businesses are laying off staff. Inflation is starting to fall sharply.
Hey, crypto legends. Welcome back to Crypto Street, where the wild ride and the crypto carnival. Buckle up because Bitcoin and Ethereum are dancing to their own tunes and the SEC is throwing some regulatory curveballs. I'm your crypto guide, and today we're diving into the thrilling world of crypto news. Let's roll. Bitcoin and Ethereum decided to play a little game of seesaw over the weekend. Bitcoin slipped by 0.12% after a Friday gain, teasing us by not quite reaching that $38,000 mark. Why the tease? Well, there's this looming deadline on January 1, 2024 for the Hashdex and Franklin Bitcoin ETFs. The SEC's got some decisions to make, and we're all on the edge of our seats. Will they, won't they? The crypto drama continues. But wait, there's more. The SEC and Coinbase are gearing up for a showdown on January 17, 2024. Judge Catherine Fela is stepping into the ring to hear arguments on Coinbase's motion to dismiss. Coinbase is throwing punches, claiming the SEC doesn't have the power to regulate crypto exchanges. Senator Cynthia Lummis is in their corner, shouting, "Let crypto innovate." It's a heavyweight battle for the ages. Now let's peek under the hood with some technical analysis. Bitcoin's flexing its muscles, holding above the 50-day and 200-day EMAs. If it breaks $38,000, get ready for a rocket to $39,000. But, and it's a big but, regulatory drama and ETF news are the puppet masters here. Keep an eye on that $37,600 support level. If it breaks, we might be in for a dip. And Ethereum, Ethereum, is holding strong above the EMAs, eyeing $2,100. Bulls are ready to charge at $2,143, but watch out if it dips below $2,021. The 14-period daily RSI is whispering sweet nothings, suggesting an Ethereum surge before it hits overbought territory. And there you have it, crypto warriors. Bitcoin's teasing us, Ethereum's flexing, and the SEC's adding some spice to the mix. Let's continue our discussion with Raoul Pal.
The forward-looking markets, technology and crypto, priced in a recession last year. And they've been recovering since because they've been following the forward-looking indicators of financial conditions and other things. Right now, stuff like the Russell 2000 and oil is living in the present day, which is slow economy. So they're at their lows. And everyone's like, what the hell is going on? Why are these tech stocks going up and everything else is going down? It's because they're forward-looking, as it is their job. So I've been very bullish. I saw the liquidity cycle, which is the key driver of all assets. The liquidity cycle is based around this interest rate cycle, which is based around this whole debt refi cycle. Liquidity started bottoming last year in October, November, December. And that gave us the signal to start getting long both crypto and technology. And that's been, phenomenally good. I mean, this year, the Nasdaq's up 45% and crypto is anywhere between 80 and 500% this year. And that's got people scratching their heads. But our forward-looking indicators of the business cycle suggest we're going into what is, right now we're in macro spring. That's when the weather kind of gets warmer every day, but sometimes it's raining and sometimes you've got a frost and other times it's hot and you're like, it's always confusing. That's macro spring. We're about to start moving towards macro summer. What is macro summer? Macro summer is when interest rates are falling, inflation is falling, and growth is picking up. That's the kind of holy grail for macro and for investing. And we should be in macro summer for all of 2024 and into 2025. And so my forward-looking basis is that the economy picks up, inflation keeps falling. I think it'll overshoot to the downside, which is the opposite of everybody else's narrative of sticky inflation. And I think the markets are already showing you how excited they are about this idea, because we've just gone through a ridiculous rate cycle, kind of an unprecedented rate cycle on the back of the unprecedented inflation. That inflation, I think, was just driven by the pandemic. If you shut down, all demand and shut down all supply and then bring it all back on at the same point, you create chaos. Exactly the same happened after World War II. After World War II, suddenly everyone came back into the labor force, and factories had to retool from making munitions to making cars and washing machines and whatever. And we got a massive inflation then. But then what happened is it worked its way through, and we just had strong growth going forward.
That wraps up today's crypto news highlights. Stay tuned for more updates, insights, and analysis from the world of cryptocurrencies. Please share your thoughts in the comments below. Don't forget to like this video and subscribe to our channel for more engaging content.